Luke Tilley joins us now to talk more about what he thinks the Fed will do next. He is the Chief Economist and Senior Investment Strategist at Wilmington Trust. Welcome, Luke. Nice to have you here.
Thank you for having me.
You think we've got one more cut from the Fed. You're pointing to a slowdown in capital spending, correct?
Yeah, that's correct. We still do think there's going to be one more cut this year, most likely in 2 weeks at that October meeting. And as Steve suggested, if not then probably in December. So I think Bill said it right when he set it up. He said that maybe those tensions have eased ever so slightly, and it really has been slight. The Fed has been cutting rates, and basically they've said for two reasons. One, because of the trade tensions, and second, because of the global slowdown in economic growth. So we've had a little bit of easing on the trade tensions with the tentative deal with the Chinese from last week. But really, we're still looking at the other risks that are still present. We've got that global slowdown. We know that our manufacturing sector has slowed considerably. It's really been hurt. And we still are slated, unless there's a solid trade deal in the works and signed, we still are slated to get more tariffs, either the ones that were postponed a little bit from they were supposed to go into effect 2 days ago, and then another set for December 15th. So those risks are still around, and enough reason, I think, for the Fed to be lowering rates one more time this year.
And then there were those retail sales numbers yesterday that were negative, actually, for the month of September. Was that an outlier in your view, or is something else going on there?
Yeah, the retail sales number was really weak on a month-over-month basis, as you point out, Bill. They had been really strong in the months before that, and they can bounce around a bit. I think really the question for the Fed is whether that slowdown in manufacturing, and there's also a little bit of a slowdown in hiring, whether it continues to bleed into the services sector. The services sector has been holding up okay. We would expect the retail sales to resume growth in the months coming ahead. But if the risks persist and if you continue to get the slowdown, if you get those tariffs, then that would really be the worry that it would bleed more into consumer spending and services.
Are you one who thinks that we are in a slowdown, or are you one who thinks that there is a recession looming?
Well, our baseline outlook is for a continued slowdown in GDP going forward, probably to something as low as 1.5% going forward. And that is based on the idea that the trade tensions don't get any worse from here. We don't get any more tariffs. We think that if the tariffs that are currently scheduled to go into place do come, that would end up pushing us even lower and possibly into a recession. But at the same time, a lot of this slowdown is because of the existing tariffs and also business uncertainty about whether there's more coming down the pike. So the possibility of upside is pretty strong. If you had a deal that removed the existing tariffs or even just convinced businesses that there were no more coming, then you would start to get some stronger CapEx, we believe, and you could get some stronger growth numbers.
So quickly, for you, trade is the biggest issue facing the Fed right now.
Yeah, it certainly is, because it's playing directly into the economic data. And of course, the economic data and economic growth and inflation is what they're basing their rate moves on.
Luke, thank you so much. Luke Tilley with Wilmington Trust.